Hello everyone, I'm Kiko Lee. Welcome to my research presentation, Dynamics Market Fingerprint, a sliding window minimal spelling tree analysis of stock market. I conduct this research as part of my project at the University of Sydney under supervision of Dr. McHarry. This presentation including 6 parts to introduce my work. I'm gonna start with the first one, research background and the literature review. This research will focus on stock market. Most countries have stock market, and stock market is a typical example of complex system, which made up of diverse assets and a wide range of participants, from individual traders to large institutions. It serves as an efficient channel for companies to raise capital and for investors to allocate resources. Structure change of stock market happens almost every second, but big shifts can be driven by policy change, like interest rate moves or regulatory reforms, or by sudden external shocks such as natural disaster or geopolitical events. Because of the tight interconnection and nonlinear feedback loops, every small structure change can trigger risk chain reaction leads to market crash. To illustrate those dynamics, I will examine 2 endogenous crashes in 2008 global financial crash and the COVID-19 crash in 2020, alongside the exogenous 2018 center crash to see how market structure changed before, during, and after the crash. Researchers believe could study stock market by analyzing price time series, and some researchers chose to use minimal spelling tree to preserve significant relationship across assets into a network. The pioneering work by Onina in 2003 built Pearson-based minimal spelling tree on 477 stock from New York Stock Exchange during Black Friday, and shows that during market crash, the network collapsed into a highly centralized scale-free topologies. Additionally, Skinnerwaki applied a similar Pearson minimal spelling tree approaching to 142 Warsaw Exchange assets across the 2008 crashes and observed the rise of single superhub or Dragon King nodes at the time of market crash. Moreover, my supervisor Mike compared Pearson correlation minimal spelling tree with mutual information minimal spelling tree on the top 113 U.S. equity from 1995 to 2008, finding that although both methods produce similar minimal spelling tree network global shapes, but different patterns in the intermediate cluster and the hubs. The key limitation across those studies is rely on a single similarity measure. In this project, we overcome this by combining multi-time series fingerprints with minimal spelling tree analysis, giving a richer multi-dimensional view of market structure dynamical analysis. On the previous slide, we saw that existing studies rely on a single similarity measure, which only tells part of the story. Our research filled this gap by introducing a multi-fingerprint minimal spelling tree framework. First, we extract over 7,000 statistical features, including entropy, wavelet, motivate, etc., from logarithm price series to build a multi-dimensional fingerprint for each asset. Next, we compute Spearman correlation between those fingerprints and construct minimal spelling tree to map how assets cluster and reshape under stress. Finally, we apply this approach across 3 events: 2008 global financial crisis and the 2018 center market crash and 2020 COVID-19 collapse, to test the consistency of those structural fingerprints and uncover hidden market dynamics. Here are our 2 main research questions. First, consistency. Can our multi-fingerprint plus minimal spelling tree framework reliably capture the same kind of structure shift in the 2008 global financial crisis, COVID-19 market crash, and the 2018 center market crash? Secondly, information gain. Beyond what a single measure like correlation coefficient or mutual information give us, do those high-dimensional fingerprints deliver extra face-distinguishing insights and a deeper understanding of market dynamics. Now, let me introduce our data and feature extracting setup. We study 3 crash events: 2008 global financial crisis, and the 2018 center crash, and the 2020 COVID-19 crash, using daily closing price downloaded from Yahoo Finance. For the 2008 crash, we tracked 200 stocks from New York Stock Exchange, spanning 20 industry sectors. For the center crash, we used 100 assets from S&P 500 across 10 sectors. And for the COVID-19 crash, we again select the same set of assets as in center crash. In each case, we compute log return over a sliding window of 44 trading days, advancing 1 day at a time. That gave us 564 windows for the 2008 period, 101 for 2018 to 2019, and 154 windows for 2018 to 2020, which covering the time of market crash from the beginning to the ending. Those windows form the basis of extracting our high-dimensional fingerprints on every asset before building the minimum explanations. Come to the part of fingerprints. First, what is a fingerprint? Think of it as a quantitative summary of one aspect of price time series, where that is linear dependence, nonlinearity, frequency content, or overall complexity. To generate those fingerprints, we use HCTSA MATLAB toolbox. In a single pass, HCTSA compute over 7,000 different features for each time series window, ranging from simple statistical like autocorrelation to advanced measure like violet entropy and fractal dimension. For each asset in each rolling window, this produce a 7,000 plus dimensional feature vectors. That vector is what we call the asset's fingerprint. Later on, we compare those high-dimensional fingerprints across assets using Spearman correlation to build our multi-fingerprint similarity matrix, and from those to generate minimum explanations. In conclusion, fingerprints turn each time series window into a rich numerical profile that capture hidden dynamics we can then map and compare. In result demonstration part, I will walk you through how I turn those 7,000 dimensional fingerprints into a distance matrix for each time window. Step 1. Normalize. We take every fingerprint vector, 1 per asset, and rescale its features into the 0-1 range. That's why no single feature dominates simply because of its magnitude. Step 2. Compute Spearman correlations. For each pair of assets, we calculate the Spearman rank correlation between their 2 fingerprint vectors. This gives us a similar matrix. For example, 100 times 100 correlation matrix for a 100 assets universe. Step 3. Transform to distance. We convert each correlation value row into a matrix distance by below distance equation. So make distance between assets from range 0 to 2, where high correlated assets will have shorter distance and lower have longer distance, which follows the intuition of what meaning of distance. Right hand side, here you can see a single 100 times 100 distance matrix from one window. Blue square meaning 2 assets have far distance, which represent low similarity relationship in their fingerprints, while warmer colors marks assets pair are highly correlated in their fingerprints, so showing shorter in distance. For those metrics in each windows, I make them into a video showing the dynamics of distance change over time. Top row are fingerprint similarity matrix for 3 events, whereas bottom row are the single measure distance matrix computed from just the daily log return correlations. By showing in video, you could feel fingerprints do provide more information than single correlation measure, especially during market crash. Let me show you in detail. Those are matrices from the window period covering the most turbulent windows for each crash. As you could see, the bottom row can only tell you every assets are highly correlated by showing strong yellow color in whole matrix, and you are hard to distinguish each asset from other assets or the sectors in the market and make any other instant of the crash. But the top row we get from fingerprints still showing different pattern, which supports the idea multi-dimensional measure could capture more information. Later on, I used Kraskow's algorithm on the fingerprint-based distance to extract the strongest link that connects all assets with minimal total distance. Each node represents an asset colored by sector, and each edge shows the most significant similarity in high-dimensional behavior, which is the fingerprint of the price series. By representing this for every window during crash, we obtain a sequence of minimum symmetry that tracks how the market structure change and review how its key relationships reshapes under stress. This let us track market from both micro and macro level by just analyzing a minimum symmetry network. On this slide, we plot the minimum symmetry degree distribution slope in each window into a time series to show the change over time for each crash. The blue line shows the slope in each window. When each drops become more negative, it means a few assets have become dominant hubs. The red dashed line marks the groups of window periods average slope for reference purpose. The range of slope in all periods are from -1.5 to -4, so this suggests the market do have scale-free characters in every time. However, notice the brown boxed period, which is in the time of market crash windows. The slope dips sharply compared to other window periods. This indicates the network become more scale-free during crash. This aligns with the found in Olinas Pearson-based minimal symmetry, which is stock network becoming more scale-free during crash, and it is surprised our fingerprint could capture the same characters. Then I measure how stable the minimal symmetry edges are from one window to the next window using the survival ratio. The single-step survival ratio, which is in top row, is the fraction of edges in the tree networks at time t that repair at time t plus 1. The 5-step survival ratio, which is a bottom row, tracks the fraction of edges that persist unchanged over 5 following windows. In the plot, blue line shows the survival ratio over time, where the red dashed line marking the mean in each group of continuous periods. Look at the brown box crash period. Both the 1-step and the 5-step ratio rise sharply compared to other periods, meaning a large fraction of edge remains unchanged in market terminally. This observation suggests a network showing a frozen behavior, which might be the cone hubs stay locked together, possibly reflecting a liquidity problem in the market where only a few key assets continue trading in close lockstep. Next, I identify the market central asset and introduce the idea of mean occupation layer. So first, start with central node selection. For each sliding window's minimal symmetry, I record which asset has the highest degree. In other words, which node is the most connected. Over the full period of each crash, I count those frequencies of being central nodes. In 2008, Oracle was the center in 13 windows, or 5.3% of the time. In the 2018 center crash, it was Google at 8.9%, and in the COVID-19 crash, Microsoft at 20.7%. I choose the single most frequency hubs as our static central nodes for each event, which means for each minimal symmetry network, we'll secure the central nodes as I selected. Next, mean occupation layer. We treat that static center as layer 0, then for each minimal symmetry, every other asset is assigned a layer equal to its hop distance from the center in the tree. The mean occupation layer is simply the average layer across all non-central assets. I show the equation here to help you to understand. A low mean occupation layer means most assets sit close to the center, indicating a tightly clustered structure. A high mean occupation layer signals a more divergent network. We compute a static mean occupation layer holding the center fixed as above, and a dynamic mean occupation layer where the center can change window by window. In the next slide, you will see how this layer matrix evolves through each crash. So we compare two ways of measuring fingerprint-based minimal span tree network compactness via the mean occupation layer. Row 1 shows the static center mean occupation layer, where we hold the most frequency hub, Oracle, Google, and Microsoft, fixed as a layer 0. Row 2 shows a dynamic center mean occupation layer, where hubs can change each window. As you could expect, the static center in row 1 curve sits generally higher than the dynamics one in row 2, because fixing the single center makes many nodes sit 0 hubs away on average. In row 3, we overlay the two mean occupation layer series, static in green, dynamic in blue. Notice that outside the crisis period, the static curve remains well above the dynamics. Crucially, during the brown boxed crash windows, the two curves converge, sometimes even coincide, and showing a significant drops. This tells us that in market terminally, the network's layer collapse into a single common structure, and markets are tied closer between assets in the perspective of fingerprint. In other words, when markets are under extreme stress, the minimal span tree locks into one fixed structure. To show a clear view of what we observed from previous slides row 3 plot, I use mean occupation layer in static center minus mean occupation layer in dynamic center, and representing the result in points. Again, we could clearly observe the convergence of market network structure in dynamic center and static center. I tagged the convergent period with green box, then checked this range of periods in VEX index, which could provide the reference of market uncertainty. It is surprising to see the green range periods covering the market's most terminating time. Well, I have to admit this result in 2018 center crash is not as significant as in other two events. This might be because center crash was driven by a more complex mix of exogenous factors, US-China trading war, BRICS uncertainty, and having high-frequency trading all happened in that years. But for other two events, I'm excited to see this beautiful result. On this slide, I repeat the same method on mean occupation layer analysis, but use only Spearman correlation of daily log return. As you could see, the results are noise and hard to interpret, and not cover the market most terminal periods. In short, the single measure minimal spanning tree are noise, blank a distinct convergence during market terminal, and fail to capture the same information we saw with the multi-fingerprints. This happened might because single correlation coefficient means multi-dimensional dynamics and is easy to disturb by noise. Now back to the fingerprints. This convergence in the network structure reminds me how water freezes into ice. Likewise, when markets under extreme stress, the high-dimensional fingerprints of asset behavior seem to freeze, locking the minimal span tree into one fixed structure. In this frozen stage, only the strongest relationships remains, just as only the strongest bonds hold molecule in an ice crystal. More evidence from the perspective of network structure. Take the example of fingerprint-based minimal span tree in 2008 global financial crisis. I tagged the freezing period by green bar. First, the drop in slope meaning fingerprint network interconnecting comes closer. Then, the survival ratio in network structure are higher compared to other periods, suggesting the lock and unchanged situation in asset-to-asset connection, reflecting problem of market liquidity. Last is mean occupation layer jobs, again shows assets in the market are come closer. Together, those suppose the market is showing frozen behavior during crisis. In this part, I will focus on the specific analysis in fingerprint frozen phenomenon in 2008 global financial crash. Questions including which fingerprint feature actually falls during a crash, and what do those frozen fingerprints tell us about the market behavior during the crash. Here we ask which individual fingerprints actually frozen during crisis. To answer that, for each feature we compute the normalized variance job score to test for those fingerprints works fine in normal periods, as it still works functional to test the difference between assets in frozen periods, or lose its functions, which means not diverge anymore, so turn into frozen state. So a large positive variance job shown in plot for those blue bar above zero means that fingerprint variance collapse in the crisis, which we say fingerprint frozen. On the bar chart, features sorted left to right shows the biggest to smallest relevant variance job. We have also grouped them by category like entropy measure, wavelet, feature, autocorrelation, and so on. Here's which fingerprint actually frozen during the 2008 crash. The bar on left show large positive variance job. Those measure collapse tightly, meaning all assets look almost identical on that fingerprint in the market frozen period. The bar on the right dip below zero, indicating fingerprints that defrozen, where assets still diverge. So now we could simply check what those fingerprints measure to get any insight about what happened in the market crash. Now, I divide some fingerprint category into 5 groups so that we could provide information about market under the perspective of tail risk, liquidity and microstructure, trend interconnectedness, complexity, and predictability. Therefore, fingerprints do provide more information than single measure. For 2008 crash, we could know from fingerprints that all asset loose shape measure collapse into a common extreme downturn profile, but in timing of those extreme divergence might by sector, same for recovering after crash, with some supported fingerprint. Instance 2 is different assets react differently during the crash. Some stocks saw much larger bid-ask spreads break and dips withdraw than others, highlighting which stock were most vulnerable and highest risk under stress, with some support fingerprint below. Come to the final part of the presentation, I have shown how our multi-fingerprint minimal spanning tree framework uncover rich high-dimensional structure in financial markets, the structure that a single correlation measure simply makes. See, specifically by extracting over 7,000 time series fingerprints per asset window, we capture nonlinear frequency and complexity signal that traditional single measure minimal spanning tree ignore. The multi-fingerprint minimal spanning tree produce stable, smooth structure changed over time, whereas Pearson-only tree are noisy and inconsistent. During both the 2008 and the 2020 crash, and to a lower significance to 2018 center crash, we observed the fingerprint frozen, revealing that assets move together on multiple dimensions under stress. For implication, regulator could monitor the defrozing of a certain fingerprints category to spot sector-specific liquidity breakdown before the spread. And for investors, might use features that retain diversity during the crash or defrozing fingerprints to inform more resilient hedging or crisis period allocate strategies. Our study covers only 3 U.S. market crash on daily data. In future work, we could consider use other markets and use high-frequency data. Well, just like the parable of the blind man and the elephant show us on one perspective, never reveal the whole truth. Our fingerprint approach is like giving dozens of hands to feel different part of the market's elephant. Together, they reveal far richer picture of the shapes. Thanks for listening. This is the end of my research project.